Since March 2014, the appeal of discretionary bypass trusts, also known as spousal bypass trusts, has been reduced. The new rules meant that you could leave your defined contribution pension to dependents other than just your spouse, and they could draw an income. In my other video called Why to Choose a Spousal or Discretionary Bypass Trust for Money Purchase Pension Benefits When You Die, it's a mouthful, isn't it? I discussed the pros and cons of setting up a spousal bypass trust. If you're not sure it's right for you, you may want to watch that video first. In this video, I'm going to outline the main tax implications and charges involved in setting up and running a spousal or discretionary bypass trust for defined contribution pensions. When the trust is created, this will give rise to what's known as a transfer of value by the settlor. That'll be you, the pension scheme member, for inheritance tax purposes. It's usual to establish the trust with just a nominal gift of £10, which falls within your available annual exemption. So as long as you don't add any assets to the trust whilst you're still alive, there will be no inheritance tax charges in your lifetime. When you die, the payment of the death benefits from your pension into the bypass trust will be tax-free if you die before your 75th birthday and the payment is made within 2 years of your death, and the funds have already been crystallised or you have sufficient remaining lifetime allowance available. If you die on or after your 75th birthday, or the death benefits are paid to the trust more than 2 years after the scheme administrator knew of your death, then the special lump sum death benefit charge of 45% will apply. The scheme administrator will deduct this amount before paying the balance to the trust. And it is important to know that there is an associated tax credit with this payment, which I'm going to hopefully explain later. As a discretionary trust, special inheritance tax charging rules apply after your death as the settlor. There may be inheritance tax charges on every 10-year anniversary of the trust. This is known as the periodic charge, or whenever property assets leave the trust, known as the exit charge. It's important to note that when property or assets move between different discretionary trusts, the trusts are treated as one for the purpose of the 10-year periodic charge and exit charge, with the start date being when the first trust began. In this instance, the member, that'll be you, will be treated as creating the trust when you first join the pension scheme. If the pension scheme paying out the death benefits received transfers in, which means if you transferred other defined contributions pensions in over different times, it will be the date of the first pension scheme that will be the start date. The calculation of inheritance tax, periodic and exit charges can be complex, especially where there have been multiple transfers into the pension from several different pension schemes over the years. It's a good idea to seek specialist advice, but the maximum liability should be just 6% of the value of the trust property at the 10-year anniversary. Most of the time it will be much less or even nil. Income generated within the trust is also subject to tax. The first £1,000 of gross income is taxed at the standard rate. So if it's dividend income, that's currently 7.5%, rising to 8.75% in April 2022. If it's any other form of income, it's taxed at 20%. Anything above the first £1,000 taken as dividends is taxed at the special trustee rate of 38.1%, which again is rising to 39.35% from April 2022. Or it's 45% on any other types of income. That's income and dividend taxes covered, but the trust assets are also liable for capital gains tax. When trust assets are sold, the process for calculating gains is the same as for individuals. The real difference is that trusts pay trust rates of capital gains tax, currently 20% or 28% for residential property. The trustees are only entitled to half the individual annual capital gains tax allowance exempt amount, which is £6,150 for each tax year until April 2026. I mentioned earlier about a tax credit associated with death benefits paid if you die after age 75. So let me explain. When the trust pays out benefits to your beneficiaries, there is a tax credit attached reflecting the 45% tax already paid. This can be offset against the beneficiary's other income in that tax year. The amount that can be claimed is the proportion of the tax charge that is attributable to the amount received by the trust beneficiary. It's complex. So let's look at an example. If two beneficiaries each receive 50% of the pension lump sum death benefit received by the trust, they can each set off against their own income tax liability 50% of the tax charge paid by the scheme administrator. For example, if the pension lump sum death benefit being paid out to each beneficiary is £5,000, they will each receive £2,750. They will also then each receive a tax credit of £2,250, which is 45% of the value of the payment received. Your scheme administrator will provide the trustees with the relevant information that they must pass on to the beneficiary for them to be able to make the claim. The beneficiary must then account for the gross amount of lump sum death benefits in their self-assessment tax return, or they can use Form R40 repayment claim form. Where the tax paid exceeds the total income tax liability for the year, HMRC will repay the difference. The tax credit is designed so that the tax on the lump sum death benefit is paid at the beneficiary's marginal rates, as if they had received the payment from the pension scheme directly. So, in theory, there's no additional cost to the beneficiary of taking this route. However, the control that the trust gives will come at a cost. So let me explain. There is no time limit for onward payment of the lump sum death benefit from the trust to the beneficiary. However, the lost compound growth on the 45% paid to HMRC when the death benefits are transferred to the bypass trust will become increasingly larger than the 45% tax credit that can be claimed when the payments are eventually made to the beneficiaries. This could be a number of years later. Whether it is a cost worth paying will be down to your own individual circumstances. As you can tell from the complexity of this video, spousal bypass trusts are complex due to the tax rules attached. So please seek advice if you are considering setting one up. They do have advantages, but I really recommend you get advice about it. Thanks for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help people live successful lives, and that often involves understanding your money. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel. And for now, I'm Justin King, helping you live your best life.